Good day to one and all. This is Dr. Sivaraman of iknowthis.com. Good day to one and all. Let me display the slide. It is My Trading System, webinar 7 in the series of 10 webinars. In order to facilitate the 10th anniversary celebrations of FX Street, I am giving a sequence of webinars to explain my trading system. In the 7th webinar, I am going to give how exactly the basic trading strategy can be decided and how exactly we can take decisions with regard to entry, stop and exit during the volatile moves in the market. So I explained in the previous webinar what are the constraints and also how we can read the intentions of the players, how we can differentiate the types of moves in the market. Then with the help of market reading, we should be able to take trading decisions. So we will be focusing more on the time-based trading decision. That is, we will try to take the position and try to close the position within the same session, following the timings of various sessions of the market during the day, 24 hours day. And also, we have to measure the amount of risk we can envisage or which we can withstand without undergoing any stress, financial stress. Then also we will be taking about 30 minutes to review the market in relation to that of the various parameters for our trading decisions. So we have to identify the moves and also we have to identify where exactly we can make an entry and exit so that we are in a position to make profit. So for all the market studies, my trading system, I use the live market code page. The link of the same I have given it here, and you can see the live market code page currently. So this is how the live market code page will be. So in that you come across the currency pairs as a symbol, and the bid and the ask, the spread between that is also shown. Then the low and the high are also seen. This is actually measured from the start of the day. Then also the net change from that of the previous day close. So ERA has gained about 21 pips from that of previous day close last Friday. Then GBP has gained about 115 pips from that of previous day close. Then you come across the GMT time. So we can track the market using the GMT time rather than using our local time. So this is the first step. We should be able to find out where exactly the market is rather than giving importance to that other level, the psychological level like 1.3100 or 1.5800 and things like that. Always keep in mind that the players will try to hit the stops above that of the psychological level or near that of the psychological level on either side. So keeping that view in mind, we will try how exactly they have just made the moves. Now it is the European session. You know the session timing. The European session starts by 7:30 GMT. I explained in the first webinar. So obviously we need to understand that the session timings are very important, and following the timing, we'll try to enter into the market. Currently the market is in the middle level. So when it is in the middle level, we need to understand that they are handling that of the crosses when compared to that of the majors. So during the late sessions, they will be handling the majors rather than the middle session. So during the start of the session and end of the session, they handle the majors, and during the mid session, in each of the sessions, the 3 sessions of the day, they handle the cross. So this is one thing we need to use as a tool. The second tool we will be using it, namely the important events for the day. What are the events you come across in a day, and whether we are going to have immediately in if you come across various websites giving this particular events which are to be released from time to time. also set it to that of the GMT. In FX Street, also in the home page, you come across the events are being displayed with the explanations, and we are more important, or we give more importance to that of the timings of the event. So you find that by 8:30 GMT, a GBP data was released, namely the manufacturing PMI, and subsequently, which is shown in black, that means not much of a change. If it is in red, obviously it is less than expected. If it is in green, it is more than expected. And also the importance of the events are given in various colors. And in FX Street, you come across with exclamation marks, either 1 mark, 2 or 3. So each website follow different styles, and you can find there what is the next event going to happen. So by 14 GMT, the ISM manufacturing PMI is being given here with a red color. So till such time the market is expected to make the swings. So this is how I'll minimize this. We try to view first of all the live market code page. Then subsequently we view whether any data is going to be released so that the market might make quick unexpected moves or a false move before that and the intentional move after that. Are we going to take trading decisions just about 15 minutes or 30 minutes before the data, or about 2-3 hours? Because when you try to look into the market about 4-5 hours beforehand, then it doesn't mean the market has to be static. The volume might be less, but still the swings will be there, and that gives a great trading opportunity. Then the next slide we have to, or the next important thing we have to look into that is namely the initial lows and the highs set for the day. On a daily basis, I give during that of the Asian session the initial lows and the highs set in the majors and the two commodity pairs. Between 5 and 5:30, I am giving the webinar, but actually I make a record of it between 2:30 and 3:30 GMT. So during that time, if you are available, you can make a note of the initial highs and the lows of each respective day, so that you will be able to understand the weekly how exactly they are taking the moves and whom they are trying to attack, either the short sellers or the long holders. Then if you are not in a position to make what is happening between 2:30 and 3:30 GMT, the initial and lows and the highs, you can just probably refer to the other charts. Around 2:30 and 3:30, what was that level we have seen? You can, in the chart, you can make a note of it as the high and the low, and just you can use it as a reference level. This is the reference level the players use in order to track the traders. Say for example, in the case of euro, the initial high was 1.3086, and currently you find 1.3088 was the high, and subsequently it is trading around 1.3061. So they made a brief upward stop for 2 pips, and then subsequently made a slide, and they are holding below that. And you know very well, this is mainly to drop euro GBP cross. That is why in the case of euro, the net change is only 13 pips, positive net change is seen, whereas in the case of GBP, the net change is about 109 pips, and the high is 1.5813, whereas the initial high was 1.5731, and then subsequently they made a brief upward stop above that, and they were holding around this particular area above that of 1.5722 for till end of the Japanese session, and then gap time they started gaining the levels, and after a small dip they again gained the levels during the early European session. Before first the 30 minutes, 7:30 to 8 GMT, they made the breach of the new high 1.5456, and then subsequently went up to 1.58, and slowly they went up to 1.5787, then 579398, then breached 1.58, and finally formed the high as 1.5813. So this particular rise is referred as the extended move, Whereas in the case of euro, they made only a brief upward stop and for 2 pips and come below that of the initial high. Then what you can do with regard to euro, near that of the initial high, we can keep a sell limit order. In the case of GBP, since they are not done the stop and they have made an extended move, we have to wait for 2 hours. Then afterwards, if we try to take a sell position and our hedging order may not be filled. So this is how we have to identify the move, whether they have done a stop or they have done an extended move, which is very, very important. And if you simply think that anything above that high immediately we can take a sell, then further rise they could make, and that may create more and more of uncertainty for us. Then in the case of USDCH at 1.04 and 0401 as the initial low, they breached the low and subsequently they formed 1.0394, a brief downward stop, and then started gaining the level. The initial high was 1.0437. They breached it and formed the new high 1.0474, and still it is hovering around 1.046367. So you can understand that they made a downward stop and then subsequently gone above that of the initial high and staying above that of the initial high for more than 2 hours. So obviously, when they are making this sort of gain, then they could make a brief dip closer to the low, closer to the initial high, and then subsequently they could gain the levels in the case of USDCH. So you have to read from time to time how exactly they are making the moves in order to find whether to do a sell and buy trade or a buy and sell trade. And in the case of yen, you find it is subdued and they have only cut the high 0.8686 the current high by 16 pips, and they are holding above that 8670. A brief upward stop was done, and they are making a consolidation here in the case of USD yen. So it is not advisable to do a sell and buy trade here. Probably a quick pullback, you can take a sell and then quickly keep stop at entry and try to make profit during this line. In the case of Australian dollar, which was vigorously rising during the morning Japanese session, and it breached the initial high 0.910 and went up above that, and it formed only 0.9133 as the high, and that high from that of the Japanese session they have not breached it. So even though they are holding it with 75 pips positive net change, they are not breached the high. So this sort of holding high is mainly to induce the traders to take long positions, or anybody still holding the sell position at the lower level, inducing them to do the short covering. So here you come across that they formed the high about 25 pips, and subsequently they are holding around 0.9116, just 10 pips above that of the initial high. Once it starts coming below that of the initial high, then you will find further dropping. So they are not breached the new high in the case of GBP 1.5813, and they are not breached the initial high in the case of Australian dollar, and they made only a brief upward stop, and in the case of euro they made a brief downward stop, and in the case of CHF. So with the reference to that of the initial lows and the initial highs, where exactly they are trying to take the market, you will be able to understand. Then what could be the next possible move? After that extended move, an intentional move has to be done. And that is what we are expecting in the case of GBP. The intentional move will be opposite of the extended move. So let us try to take a decision with regard to the trading and see what happens to that. So this is how we have to make a comparison of the initial lows and the highs. In the case of Canadian dollar, 1.0263 was the initial low. They breached and gone below and formed a new low, 1.0228, and it is currently holding near that of the low. And they made a drop of about 60 pips. Now net change is 60 pips. So actually from that of the low, they dropped about 40 pips, and they are holding here and stop cutting the low. So what could be the next move? they have made an extended downward move, then obviously the next move will be intentional move. And we have to identify how exactly the intentional moves are to be expected. I'll explain with the help of the slide. Let me focus the camera over the PowerPoint presentation. Then the time-based trading decision. So first of all, we have to wait for the quick move to happen in the market. So whenever the market is subdued, don't enter into the market, and your holding time will be more rather than closing the position with a profit. So there is no point in holding the position for 2-3 hours. You should be able to quickly grab the profit, and there should be a great opportunity for that. So we have to always look for the quick moves to happen, and these sort of quick moves will be seen during the session start time and the session close time rather than the mid session. Now we are watching the mid session, so you come across the moves are very subdued. Then session start and the session close times give great trading opportunity. So when the market is near the low, market in the sense 0 or GBP, that's what I refer to. So whether it is near that of the high or near that of the low, then you come across the quick moves happen. So if they come closer to the high, are they breaching the high again? You have to see. And they started in the case of GBP around the breaching of the high around 7:45 GMT. Then 2 hours if you give, it will be about 10:45 GMT, 9:45 GMT. To be on the safe side, if you wait till 10 GMT, you find that they are not breaching the high. So they are making a small swing between the high and the low, between the earlier high and the new high. That is how they make the swing, which is referred as a pump and dump move. Anybody losing the patience try to come here and buy, they try to sell it to them. Then subsequently they are expected to show the intentional move. And sometimes the intentional move they may do after a brief upward stopping, or sometimes they may straight away continue with the intentional move. So we will identify how exactly they are going to do that. Then watch the high, low and the net change of all the currency pairs from time to time before taking a position. Spend about 30 minutes. See whether there is a quick move available. Are they near the high or the low? How much of net change they have made it? And look into all the 6 currency pairs and see which currency pair they are handling, and also see the cross, whether they are busy with handling the crosses or they are handling the names. As I explained, mid sessions they will be busy in handling the crosses, and one of that you come across now, they are handling Euro GBP, making a drop. So holding Euro and gaining the levels in the case of GBP, whereas in the case of Euro they gained only 21, whereas in the case of GBP they gained about 116 pips now. So as a result, Euro GBP has come down. So which has made a negative net change of 46 pips, and they are holding it near the low in the case of Euro GBP. So you are able to find that they are handling the process. There's no point in taking positions in majors. If interested, we can try to trade in crosses. Otherwise, wait for the late session. The late session starts around 11:30 GMT up to 13 GMT. That during that time, they will be making quick moves. And when they come closer to high, then you can take a position. Now we don't have time, or probably we will not be able to watch the market during that 13 minutes. Probably we may have to attend to other work, and later on you want to come. So then how exactly we can take a trading, keeping the constraints of the platform. So then we have to decide. So it is not only the market we have to study by market reading, and also with regard to the various data release time. It is also pertaining to that of the constraints in the platform. They may not give a definite fill, and the platform might show slippage, etc. So how exactly we can handle all those things while taking trading decisions? So we have to develop the insight. First of all, what appears in the market is not true. It is like the null hypothesis. So in statistics, you might be knowing that whenever you wanted to prove a concept, we have to develop the contrary or the corollary to that, and see that it is not going to happen and try to test it. Then if that result come as a significant result with regard to the probability, then we go in for confirming or rejecting the null hypothesis and accepting the hypothesis. So the hypothesis development is nothing but a concept, and subsequently the null hypothesis is nothing but trying to reject it and try to prove it statistically whether it is correct or wrong, so that we come across an objectivity to it. So develop the insight. What appears in the market is not true all the time. Then, okay, this is what we come across. So after the raise, you decide or you are able to develop the insight. The players have gained the levels only to induce the traders to take a buy position. So obviously we have to take a sell position. But appropriate level we have to decide. Then take only one lot trade at a time. If you are having less than $30,000 as a usable margin, try to take one mini lot. If it is more than $30,000 as a usable margin, try to take one standard lot, irrespective of the leverage what you are trying to use. Then, when able to keep the stop at entry, you can think of another trade. Till such time, don't think that let me take 3 lots at a time and make some partial booking of the profit in one lot. The other lot, you try to maximize the profit. The third position, we take more risk and things like that. Invariably, the players are not going to make that sort of moves in the market, one straight downward or one straight upward move, and they will be making volatile moves and also bring in intraday trend reversal moves, and all your plans might be tempered or might be totally altered when they make quick moves, and you will not be able to stick on to your particular trading decision. The best thing is you take one lot. Okay, whatever be the study you use for market reading, try to take one lot position, and if the position start making 20-30% profit, keep stop at entry so that the risk is reduced to nil. Then subsequently you think of taking another position in the same direction. Suppose you have taken a GBB sell position and you are able to keep stop at entry and still the stop is not filled for 30 minutes of observation, take another position, sell position at a lower level in GBB. Doesn't matter, because the second position alone you will be keeping a hedging order to limit the risk, and the first position is free of risk now. So at any given time, only one position can be just taken for risk, and you should not take more positions and later on think of crisis management. Then also see that your position takes only 1% of your total usable margin or lesser than that, not more than 1% at a given time. You might think that if I try to do a mini lot, probably I can earn $50 or $100 and things like that. It may not be a workable solution because I want to take trading as a full-time profession. So obviously I want to make more money. In the process, you might be induced to take more positions and you might lose the money. And subsequently, in order to earn back that money, you might be spending more and more time, try to take more risk, and invariably you'll find that the going becomes very, very tough. So obviously you have to restrict yourself with regard to the position. And even if you are earning about $50 to $100 per day, if you are able to trade only 20 trades or 25 trades in a month, still it will be $500 to $1,000 you will be able to earn. And whenever the going is good, you may not be able to earn only $50. You might be earning even $200, $250 in one mini lot. And also I explained that you can take a position, keep stop at entry after it's making profit, then subsequently expose another position, so that in both the positions you can earn money. So there comes your intelligence rather than trying to act with a market fear. So at any given time, in this age, the market can go against me. Okay, if it goes against me, how much of risk I can tolerate? And if you try to keep a stop of 70 pips, 100 pips and things like that, also think whether I am prepared to take that much of risk. My usable margin, whether it will permit me to take that much of risk. You have to take into consideration, if somebody says that keep a stop of 150 pips, it might be convenient for a trader who has got about $50,000 or $70,000 to keep about 100 pips stop, whether it is possible for you. In the event when you are not willing to take that sort of risk, then avoid using stop in a loss-making position. At least use hedging. So once you use the hedging order, the hedging might be filled. You might be blocking 70 pips, but still you will be holding the positions for you to earn on either way moves of the market. Use the stop, then position is closed with a realized loss. So you should be able to understand the difference between using the hedging and also using the stop. So I will explain in the next webinar how to effectively use the hedging, and in this I will be focusing more on how to take trading decisions. Then the high-low net change I explained. Check whether the high or the low are set after stop or extended move. In the case of the GBP, you found that there was a stop and subsequently they are not breached the new high. In the case of GBP, they made an extended move. So you are able to understand, in the case of Euro, they made a stop, and in the case of GBP, they made the extended move. How you define that extended move? When they go above that of the initial high and stay above that of the initial high for more than 30 minutes, then they have got a potential to rise for another 1.5 hours. So you have to wait for 2 hours, and later on you see that they don't cut the high. Now you find that GBP, they come closer to the high. Why they are not cutting the high? Nobody prevents them not to breach that high, because they have a style of making moves in the market. So we need to identify that. Then they have done that extended move, and obviously many of the traders who have taken the sell position, they would have just covered it, and now people are aiming that it could go to 1.59, and obviously if you have lost money in your sell side, then you might be tempted to do a buy and sell trade. Instead, if you use the hedging order, suppose you have taken an initial high, by mistake you have taken a sell position and your hedging is filled and the hedging is making profit, that is equal to that of a buy and sell trade. So, and how to handle the sell position, I'll explain it during the next webinar, how to handle the trade. Then check whether net change is positive or negative, or greater than or less than 75%. In the case of Australian dollar, you come across the net change has not breached 75 pips today. Whereas in the case of GBP, they have breached more than 75 pips. So you come across two examples today in today's market. And so if they had come up to that of 75 pips and not breached, there is a scope of reversal very fast. Whereas if they have breached the 75 pips and then they are staying with 100 pips net change, then probably they will make use of it to threaten the traders during the next session also with a little bit of stop and during the gap time or session start, then subsequently make the reversal move. So if they are done only 75% net change, then sell and buy trade can be initiated after 2 hours. If they are done for 2 hours extended move and not stop cutting the high, we can take a sell, but we should aim for only a profit of 35 cents. If you want a good profit to happen, then wait for the next session and try to take a sell position. You'll find the intentional move will be shown in the case of GBP. So let us review this and continue it at the blog, because I may not have time to continue it in the webinar with regard to the moves. You can just observe it and make the remark in this, whether our readings are correct or not, so that we'll be able to rectify or fine-tune our reading. And I want the traders to develop the insight with regard to the readings, rather than me telling all the time how exactly to be read and things like that. Then compare with that of the initial high and the low each time. Whenever there is a quick move in the market happening, we look into that of the candle, it might show about 20-30 pips gain, but the green candle or a blue candle might look very big. Immediately you will find another candle. You think that it has gone up very fast, whereas if you look into that of the net change, it has hardly gone up by 40 pips. So you should be able to quantify that. Unfortunately, when the spread is narrow, the candle will be magnified. When the spread is high, if you take a larger time frame, then obviously the candle formation will look smaller. So you have to understand the subjectivity involved in using these charts, and accordingly you have to refer to that of the net change and understand how much of move they have done it, so that you don't get the market fear from time to time. Because you have to eliminate the market fear and try to see that you don't get that market fear. Only then you become a successful trader. So it is something like a person who is driving the car. If he is upright and if he thinks that somebody might cross across or somebody might come across on the opposite side, if he thinks all the time like that, he will not be able to make a safe drive. Whereas he knows that how to use the brake and how to avoid the accidents, etc. So in the same way, you should be prepared for that, and you can keep it as a contingency plan and need not develop the market fear. Then watch whether the USD gaining move or a USD weakening move is in the cross. So currently, if you see the GBP has shown USD weakening move, Euro has shown a nominal USD weakening move, whereas Swiss franc is showing USD gaining move. It is a contrarian move. So when they are doing contrarian move, then it is not a real USD weakening or the USD strengthening. They are making up and down moves in order to handle the cross. Don't think that immediately USD is going to lose in a big way or USD is going to gain in a big way. So identify whether they are doing contrarian move or they are doing USD gaining move or USD weakening move. Why it is necessary? Because in the event if you don't have the hedging facility in the same currency pair in the trading platform, then you may think of taking the opposite position in the related currency. For example, if you have taken a sell position in the case of GBP, and if you try to take a buy position in Euro as a hedging, then your buy position may also make loss, and it may not make profit, or it may not avert the erosion of the usable margin. So you need to understand whether they are making a contrarian move. And during the session start and session close time, they will be making either the USD weakening or the USD gaining move. During that time, you can use it for hedging, but immediately you have to identify what is the correct currency pair which is making opposite of the currency pair in which you are taking position. Then only you will be able to use it effectively as a hedging, whether when they are making USD gaining or the USD weakening. The contrarian moves are to handle the crosses, so at that time you can focus on the cross. Then any data release time to be followed immediately, you have to look into it. I explained it. Identify the move and take trading positions. I explained that whether it is a stop and or an extended move, whether it is a false move or it is a stop and, you should be able to differentiate these moves. Whether it is an intentional move or a slow gaining of the level or a quick gaining of the levels and holding and subsequently slow slide. And a slow move on the opposite of the extended move is an intentional move. And also you come across extended stop and that also you should keep it in mind. Hence, at any time they may make the extended stop and so you cannot take unlimited risk or become surprised. Hence, I request you traders to use the hedging order to limit the risk, and normally they do it by releasing unscheduled data like a downgrade or an upgrade of a currency or a country and bonds, etc. And sometimes they simply create a rumor and make such moves. Then you have to identify the stop and the extended moves. Then in a demo trading platform, you try to take position during that of the stop and see whether the position is making profit. And during extended stop, you try to take a sell position near the high, above the high, or a buy position near the low, and see whether they are making profit. You will be able to really differentiate, and because practically you have to understand that in relation to that, the time taken, a stop will be for less than 30 minutes, extended move will be for around 2 hours. So in case you come across this set of moves and you are not able to identify the move, at least wait for 30 minutes before entering into the market, or safely 2 hours. Calmly wait and without a position watch the market rather than simply taking the position and praying to God that the market should be moving in our favor. Then when the market cuts the high up and low, you have to identify whether it is a stop end or an extended move. And you know that when they just go up to that of the high and then drop and cut the low, then it is a false move. After the false move, they always make a downward extended move if the false move was on the upside. So if you are able to recognize a false move immediately when they come up to that of the low, then not breach the low, you can take a buy position and keep the hedging order, and that will be able to really give you a profit booking opportunity. Then watch the net change during the quick rise or the quick fall, whether they have reached up to that of the permitted level of 150 pips in the case of euro or 50 pips in the case of GBP, etc. When they have done it during that of the early sessions, like Japanese session itself, all the permitted level for the day they have finished it, then you have to question it, why they have done it. Because they had done it mainly to gain the levels or lose the level and wanted to reverse or create and make the intentional move on the same day. Normally they do the extended move either from that of the mid or late European session and continue through US session. The next day Japanese session they continue to do the intentional move. Sometimes they make the extended move during the Japanese session itself. Then they may continue till that of the early European session, then afterwards reverse. So you should be able to identify with the help of the net change, net permissible level and the current net change, compare and decide or come to the conclusion that they have done it in a hurry mainly to reverse the market. So you have to differentiate that with the help of the net change, whether they intend to make the intentional move on the same day or the next day. So for that you have to identify when exactly during the Japanese or the European or US session that sort of extended moves happen. Always keep in mind the extended moves, they do it whenever the volume improves. But today, for example, during the start of the month itself, in the case of GBP, they have made an extended move. Why? This is mainly to gain the levels by circular trades. You will be able to differentiate it, why they have done it in the absence of reduced volume, an extended move in the case of GBP. By tomorrow, day after, or after that, you will be able to understand why they have made that extended move. If you make a note of it, the type of moves they are doing it, you can understand always they follow it in sequence. Then also you try to watch the gap time moves. And gap time moves are false moves I explained to you. And suppose they made an extended move and subsequently during the gap time they are making a drop, understand they wanted to continue during the early next session and afterwards they may reverse it. So gap time move also helps us in order to identify when exactly they are going to make the reverse. They may not do the reversal in the same session, then it will look ridiculous. No, they gain the levels using so many attributes and afterwards or a data release, they used it as a trigger and gain the levels, and simply if they drop the level in the same session, then people will say that why suddenly the currency has reversed it. So to be on the safe side, what they do is the next session, when the next data is released, then they try to reverse it so that it may appear meaningful. So keep that in mind that the players try to keep the market meaningful but still continue to give a lot of surprise. Then avoid holding loss-making positions for more than 2 hours. This is very, very important for the small traders. And if you see that the loss is gradually increasing in the 2 hours, you try to accept the loss rather than simply hold it. And otherwise, if you have the hedging facility, immediately hedge the market and try to see that on the other side move, you are trying to book some profit. Suppose you are taken a buy position in euro and suddenly euro has dropped and you have hedged it and the hedging is making about 40-50 pips profit. Doesn't matter. The next climbing up, you try to close the buy position with a nominal loss so that at the end of the day you are able to take a net profit. So you have to use the different type of trading strategies in order to effectively come out of such situations rather than trying to become panic, simply holding it without any sort of trading strategy. Now, as far as any currency, You should not have a sentimental attachment. That is, it is only in euro I will trade or only in GBP I will trade. GBP has gone up so much, so I will not take position there. Or euro has dropped so much, so I will not take any position there. It is not a safe currency. So if you simply assume like that, then immediately uh, you avoid that particular currency watching it. So obviously you cannot neglect any currency. You have to watch all the four majors in the two commodity pairs because the players make moves in all those currencies differentially from time to time. And you need not think that always I should do trades in euro. Instead, wherever you come across a good trading opportunity, you can try to take that particular position. Whether the profit is made by euro or a profit is made by GBP, it doesn't make any difference. It comes only in dollars if you have got a dollar account. Okay. Then sell near the high or buy near the low set for the day will be a typical trading strategy. When the high and low are not breached from the start of the session for 30 minutes, that I have been explaining elaborately during my tracking the forex market webinar time. So in the event if the high has been breached or the low has been breached, how exactly you have to handle it? So probably I thought that I can focus more on that. Then secondly, I will explain what sort of trade we can think of. Then use stop entry or use stop or entry stop to limit the risk. Always you have to think of the stop. Whenever you try to take an entry, think of it as entry, immediately think of the stop. Then once the entry becomes profitable, keep stop at entry, then think of an exit. So we can have a predetermined exit, but you need not keep a limit order. But depending upon the move, we can maximize the profit by trailing the stop and keep the limit at a higher level because you are willing to accept a small profit using a trailing stop or willing to accept a bigger profit using a limit. So that way, either it is a small or a big profit, you are assured of the profit after keeping stop at entry and converting into a trailing stop. Always aim to do swing trade. That should be our priority. Immediately don't think that, okay, let me take a sell position in the euro at 1.3077. So let it come to 1.25, then I'll book profit. I am only thinking of position trading. If you think like that, you develop a mental block and you are not in a position to use the trading strategy effectively. And you will immediately calculate, oh, I got about $30,000. I got only one position here. So I need not trade without a stop. And even if euro goes to 1.35, my position will be held and nothing will happen. But if it comes to 1.35, you would have seen that nearly about 25% of the usable margin might have been eroded. Besides, the platform will be charging overnight interest. Then you become distressed. So initially, you may be willing to take an unlimited risk. But later on, when the real risk happens, you might become panic. So instead, you decide now itself, no, I will not be able to withstand that big loss of $5,000 or $6,000, even though my usable margin is $30,000. Still, I will only limit the risk to $300 or $400. So I'll keep a stop of 30 pips or 40 pips, not beyond that. So you should be able to, why 30 pips? Another question. Because the swings, if you watch carefully, they do it for about 15 to 21 pips. So if you keep a 30 pip stop, it is relatively safer when compared to keeping a very tight stop. And keeping stop at entry doesn't matter at all. No, if they hit it also, you don't lose anything. You only lose the position. That is not a difficulty. You can re-enter into the market because you have got the usable margin and you have got the platform before you. Anytime you can re-enter into the market. Then try to exit out of the position within the same session. That is very important. Don't have a predetermined limit. And sometimes if the limit is not being achieved, then you might get struck. So always follow the time and see that, okay, Japanese session, I am entering short position. Then before the close of the session, let me close the position with a nominal profit. Next session, I'll think of another trade rather than holding the same position. Otherwise, you can keep stop at entry, then you can continue to hold the position for the next session also. Then, once your position is closed, at least give about 30 minutes to 2 hours. before taking another position. Because look for a good trading opportunity to take position rather than simply entering into the market by becoming addicted to trading. Then the entry sell is near the high, then exit near the low as a swing trade. The entry is above that of the high, a buy or a sell position. Then exit around the net permissible level. This is pertaining to that of the technical trade. I explained that when the GBP has cut the high and stayed above that of the initial high for more than 30 minutes, I can do a technical trade of buy above that of the high and keep stop or a entry stop order below that of the initial high. Then once the market goes up, then I can see that they stop cutting the high or they reach the net permissible level of 250 pips, whichever comes first. I'll just, or 2 hours, I try to close the position with a profit. So you can use the net change to determine your exit level, or you can use the time to exit. So there is no hard and fast rule that they have to respect the resistance and the support. So probably you may see that today they are respecting the resistance and tomorrow they will be trading above that of the resistance of yesterday's resistance. So there is no hard and fast rule or a guarantee that it will be a permanent resistance or a permanent support. You have to keep it in mind. Then whatever they show it as a high, around that you try to close it if you are doing a technical trade. And technical trade don't carry it to the next session. Then the stop can be 30 to 45 pips maximum. Beyond that it is riskier and your usable margin might go off very fast. Then wider stops are riskier. Instead you think of hedging. Suppose you want to keep a stop of 75 pips. Don't use the common stop. Instead, you use the hedging order. Now, let me come to that as a trading decision. So, first of all, in the case of a sample trade, I want to show it because I don't have much time now. So, euro, a limit order, I want to keep it. So, you know what is the limit here? The high is 1.3088. The initial high was 1.3078. They made an upward stop and then subsequently made a drop. And currently, euro is trading around 1.3074, 1.3076, and it is holding. So obviously, about 10 pips swing they could be able to make or come closer to that of the high and then make a drop. So I will keep a limit order 1.3084, just 4 pips below that of, because the spread might be about 2 to 3 pips. So I am trying to keep a limit order 1.3084. Currently euro is trading around 1.3074. So this is how, keeping into mind that the platform might give a slippage. So I will keep a limit order slightly above that of the market when I am doing a sell order. So it will be a sell limit order. And also it is closer to that of the high 1.3088. They may go up to that of the high or they may make a brief upward stop depending upon the pending positions of the traders. But they had done the stop and during the Japanese session. Afterwards they are not done upward stopping. So there is less chance of an upward stopping. But still, if they want, they can do it. So I am keeping an entry stop of 30 pips above. So that will be 1.3114. So this is how I take a decision that I have to keep a entry stop. Then I have to think of a limit. Then this limit you should not keep immediately in case if you are using a hedging order. Because if the market quickly goes up and hedge your position and subsequently drop and fill your limit, then what will happen? You will hold a higher level buy and this sell will be closed with a profit of 30-40 pips and you will be struck with a higher level buy position without a hedging order. So when you are keeping a hedging order immediately, you should not keep the limit. But once you are able to keep stop at entry, then think of a limit, and then that can be about 30, 45 pips or 75 pips or near the low. So today's low is 1.3051. So it's hardly about 30 pips. So it covers automatically. In case if there is about 100 pips, low is near around 100 pips, then probably that particular low we can keep it as the limit. Now for just theoretical purpose, I am keeping it 1.3051 as the low set for today, and we will see how exactly they are making the moves. If they just go and fill your order, fine. They are not fill your order, don't feel that you have missed that opportunity. Market continues to give the trading opportunity. Keep always that in mind. Now many of the people are more worried about GBP when it has made the rise. So let us take a position here. They just briefly cut the high again. 1.5813 was the initial the high, and then reached it and formed 1.5818, and then again come below 1.5810. So they are trying to hit the stops and creating the fear. Yeah. So we will try to keep a limit order 1.5815, and similarly 30 pips entry stop order, and a limit can be near that below, and see how exactly the market comes down. So you just track it, this particular trade in a demoting platform, and see how exactly the trade goes. If it is hedged, then you follow it day after tomorrow's webinar. At that time, I'll explain to you how exactly using the hedging you will be able to really trade either way in the market. There are various hedging trading strategies. I will explain some of the hedging strategies. Beyond that, you can think of, and you'll be able to really understand that. Now, let me focus the camera over the Develai Market page and take up the questions that are asked here. Okay, not many questions. Wrong. We will not be able to read like you, as we have the forecast model. There is nothing of that kind, please. Market reading, we don't require the forecast model really, and you are trying to do the intraday trade, and for that this sort of market reading is enough. If you have the mindset to do it, definitely you will be able to achieve it. Okay. Then no more questions. Then I'll show the last slide. So I take this opportunity to thank FX Street and the participants who have come here, and probably some of the questions if it is asked in the blog, I'll be willing to answer those questions. Day after tomorrow, 4th of August, between 12:30 and 13:15 GMT, I'll be giving strategic trading techniques. Now, basic trading, I explained how to decide on the entry, exit, and also the stop. I'll be explaining how to use the hedging, or without hedging also, how you can trade effectively and make money from the market. So thank you for your patience, and I'll come again tomorrow during the Asian session live. Thank you all. Bye.